and welcome to week 3 of the Tax Foundation State Tax Policy Bootcamp. My name is Catherine Lawhead, Director of State Tax Projects at the Tax Foundation, and I want to thank you for tuning in today. If you've already watched parts 1 and 2 on property taxes and corporate income taxes, welcome back. And if you're tuning in for the first time, thank you for joining us. For anyone who may not be familiar with the Tax Foundation, we are a nonprofit, nonpartisan tax policy research organization that conducts research and analysis on state tax policy issues, and as well as federal and international tax policy issues. And if you're a state lawmaker or staffer, you may have received a copy of our Facts and Figures publication in the mail, or you may be familiar with our State Tax Competitiveness Index, which ranks states according to the competitiveness of their tax structures. In addition to those annual publications, we also have a lot of white papers, blog posts, and other resources on a wide range of topics on our website. So we hope you'll check those out. And if you would like to receive any email updates as new resources get published, be sure to subscribe to our e-newsletter, which you can also do from our website. If any questions arise as you watch this webinar, I'd love to hear from you directly, and you can send me an email at klawhead@taxfoundation.org. And I will note that we do work with a lot of state legislators and staffers around the country, so in the weeks and months ahead, if there is anything we can do to be helpful to you, please don't hesitate to reach out to myself or the other members of the state team. Finally, a copy of the slide deck from today's presentation, along with links to the resources that are related to this presentation, will be available at taxfoundation.org/bootcamp. So without any further ado, let's jump into today's topic, which is state individual income taxes. One fact that many people find surprising is that the first state individual income tax was actually adopted in the United States before the modern federal income tax was adopted. Wisconsin adopted the nation's first state income tax in 1911, followed by Mississippi in 1912, but it wasn't until 1913 that the modern federal income tax was established with the ratification of the 16th Amendment. Today, 41 states and the District of Columbia levy individual income taxes that apply to individual income broadly, including wage and salary income, as well as investment income, such as interest, dividends, and capital gains income, as well as retirement distributions and other forms of income depending on the state. One additional state, Washington, taxes the long-term capital gains income of high earners only, but does not currently tax other forms of income. So that leaves 8 states, Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, and Wyoming, that do not levy individual income taxes at all. Of the states that do not levy an individual income tax, only 3 of them have ever levied any type of individual income tax in their history. And those states are Alaska, Tennessee, and New Hampshire. Alaska had an income tax for about 30 years, but as oil and natural gas revenue grew, the state became less dependent on the income tax and eventually repealed the tax, effective January 1st, 1979. Tennessee also used to levy a tax, but that was on just interest and dividends income, known as the Hall tax, and that tax was phased out over several years and was eliminated entirely in 2021. Similarly, New Hampshire also had a tax on interest and dividends income known as the I&D tax, but that tax was also phased out over several years and was eliminated in 2025. Today, individual income taxes comprise 33% of total state tax collections across the country, making them the largest source of state tax revenue in the United States, followed closely by sales taxes. And when you look at total state and local tax collections combined, individual income taxes comprise 22% of the total. So now that we've talked about the history of state income taxes, I'll spend most of the rest of my time today talking about their structure, starting with a discussion of states' income tax starting point and how they conform to the federal tax code. As most of us are well aware, individual income tax codes vary greatly from state to state because states have a lot of flexibility to design their tax codes as they see fit, as long as they stay within the bounds of certain constitutional constraints and a handful of federal laws. As a result, no 2 state income tax codes are alike, and in fact, there are pretty dramatic differences from state to state, and those differences start at even the most foundational level of how income is defined. When it comes to defining what types of income are subject to taxation, most states piggyback on federal definitions of income to some degree. And that makes a lot of sense because when states conform to federal definitions of adjusted gross income or federal taxable income, that saves taxpayers a lot of hassle because it allows taxpayers to run those preliminary calculations just once on their federal Form 1040 and then carry those starting point numbers over to their state tax forms. This is very helpful because it means that once you take the time to fill out your federal tax forms correctly, filling out your state tax forms should hopefully take less time. And this also saves states a lot of hassle because it means states can incorporate IRS definitions and decisions into their own tax administration. And they can also lean heavily on federal audits in conducting any state level audits. Currently, most states use federal adjusted gross income, or AGI, as the starting point for calculating state income tax liability. AGI is a broad definition of income that includes income from wages, salaries, interest, dividends, retirement income, Social Security benefits, capital gains, business, and other sources. And as you can see from the table on the screen, included in AGI are deductions or subtractions for things like contributions to individual retirement arrangements or health savings accounts, interests on student loans, certain self-employment expenses like health insurance contributions, and half of the self-employment tax. Meanwhile, there are 7 states that use federal taxable income, or FTI, as their income tax starting point, and those states are Colorado, Idaho, Iowa, Montana, North Dakota, Oregon, and South Carolina. FTI is a lower amount than AGI because FTI is AGI after the federal standard deduction or itemized deductions have already been claimed and after a 20% deduction for qualified pass-through business income, when applicable, has also been claimed. And the personal exemption also used to be included here, but the Tax Cuts and Jobs Act temporarily zeroed out the federal personal exemption, and the One Big Beautiful Bill Act made that policy permanent. It's also worth mentioning that 5 states, Alabama, Arkansas, Mississippi, New Jersey, and Pennsylvania, have established their own definitions of income that do not reference federal AGI or FTI. However, some of these states do use certain federal calculations elsewhere in their income tax codes, even if not as their starting point. It's also very important to note that regardless of the income starting point states use, states make a wide variety of modifications to those starting points, including selectively conforming to or decoupling from various federal provisions, or even adding their own provisions. For example, many states offer their own standard deduction while others match the federal one, and still others have no standard deduction at all. Meanwhile, almost every state with an income tax offers a variety of itemized deductions that differ slightly or greatly from the federal itemized deductions. And sometimes states add things back too, taxing sources of income that the federal government excludes from its own calculations. As a result, this can make comparing state tax codes a lot like comparing apples to oranges. So now this brings us to the topic of conformity, and as we've just discussed, most states rely on the Federal Internal Revenue Code, or IRC, to some degree. But a very important question to ask is, what version of the IRC does your state conform to? Currently, 17 states conform to the IRC as it existed on a certain date and time, using what's called static conformity or fixed date conformity, while 20 states and DC conform to the current version of the IRC, whatever that may be now or in the future, using what's called rolling conformity. So for example, a state that conforms to the IRC as it existed on January 1st, 2025, would not bring in the changes made by the OBBBA, since that law wasn't enacted until July 4th, 2025. However, in a rolling conformity state, those changes took effect automatically, at least to the degree that the state had not previously decoupled from the specific IRC provisions that were amended by the OB3 law. Again, it's important to keep in mind that rolling conformity states don't conform to everything. Some expressly decouple from various provisions, most commonly corporate income tax provisions like the federal treatment of international income or bonus depreciation or net operating losses, among others. But to the extent that a rolling conformity state does conform to various IRC provisions and definitions, it always conforms to the current version of those provisions. So going back to static conformity, in many states that use static conformity, Enacting legislation to update the state's IRC conformity date is typically a routine process with legislation enacted every year to update the state's static conformity date to the end of the prior year or the beginning of the current one. So, for example, this legislative session, many states are in the process of updating their static conformity dates to January 1st, 2026. When static conformity dates are updated routinely, that provides important predictability to taxpayers because if a state has updated its conformity date every year for the past decade, taxpayers can reasonably expect the state will continue to do so and they can make tax planning decisions accordingly. But sometimes this process can get pretty controversial, such as after major changes to the federal tax code are enacted. And we're seeing that play out this year as many states have already adopted or, again, are considering changes to their conformity statutes post OB3. Interestingly, after the TCJA was enacted in 2017, some states' conformity dates fell 2 or 3 years behind, and until recently, some states had fallen very behind and had stopped updating their conformity statutes altogether. So, for example, until recently, Massachusetts conformed to the IRC as it existed in 2005, and California just recently updated its static conformity date from 2015 to 2025. So as you can imagine, conforming to an outdated version of the IRC, especially a really outdated version like that, can get very complex very quickly. And in cases like these, state tax forms will still very likely begin with some federal calculation, but then there will need to be a lot of state modifications to reflect what the tax code actually looked like years ago. So it's important to keep in mind also that the IRC, the tax code, is more than just the IRC itself. The IRC is about 4 million words long, which is quite a lot, but there's also something called the Standard Federal Tax Reporter that runs about 75,000 pages long because it includes Treasury guidance, court decisions, and other information that has a bearing on how we interpret and apply the tax code. But questions can arise here because if a court rules on a tax question pertaining to the current version of the IRC, but your state conforms to an outdated version of the IRC that is slightly different, that raises the question of whether your state will bring in that case law into its own tax code. And revenue departments spend a lot of time grappling with questions like these, and corporations also spend a lot of time trying to make these determinations and sometimes even entering into litigation with state tax departments over disagreements over things like this. So one of the biggest drawbacks of static conformity is that it can create a lot of complexity, and it also requires lawmakers to proactively enact conformity legislation ideally every single year. Rolling conformity, on the other hand, provides much more certainty to taxpayers and is less confusing to administer and comply with, and it still gives policymakers the opportunity to decouple from changes they do not wish to bring into their own tax codes if they decide to do that. And then finally, in addition to rolling and static conformity, 4 states use what's called selective conformity for individual income tax purposes. So this is a bit confusing because to some degree, all states pick and choose what they want to conform to up to a point, but these 4 states, Arkansas, Mississippi, and New Jersey, plus Pennsylvania for individual income tax purposes only, diverge so widely from that IRC, including things only here and there, that it doesn't really make sense to categorize those states as either rolling or static conformity states. Now, since many states are grappling with IRC conformity decisions this legislative session, I want to spend a little time talking about OB3 conformity specifically. So when the OB3 was first enacted, a lot of people wondered how it would affect their own state's tax codes. And while the OB3's individual income tax provisions do affect some states, the impact isn't nearly as pronounced as it could have been because a lot of the changes that were made to the individual provisions happen lower down on the federal tax form. So they don't affect how federal AGI is calculated, but they do affect how FTI is calculated. Specifically, because most states use AGI, the higher number, as their starting point, most states won't be affected by many of the new deductions, such as for tips, or overtime, or auto loan interest, because those subtractions happen after AGI has already been calculated. So only the 7 states that use FTI as their starting point were or are potentially on track to potentially bring in these new deductions, either automatically in the states that use rolling conformity, or when they update their static conformity date in the states that use static conformity. So if your state uses AGI as its starting point, these new deductions won't be offered at the state level unless your state proactively adopts a law with new language to bring in these calculations. When it comes to the OB3's changes to the federal standard deduction, OB3 extended and even slightly increased the standard deduction instead of allowing it to revert to the pre-TCJ amount. So if your state uses rolling conformity and has FTI as its starting point, the new higher standard deduction amount will be included in the calculation of FTI automatically. And there are plenty of states that use AGI as their starting point, so they don't bring in that calculation automatically into their starting point, but they do proactively conform to the federal standard deduction. So the higher standard deduction amount will, in those cases, flow through to a lot of states, either automatically or once they adopt a new static conformity date that is post OB3. So right now, in states that generally conform to the federal standard deduction but remain conformed to a pre-OB3 version of the IRC, those states technically now conform to a much lower standard deduction. Specifically, since the TCJ's increases to the standard deduction were temporary and would have expired after 2025 if OB3 were not enacted, technically some states have now gone from offering a $15,000 standard deduction in 2025 to an $8,350 standard deduction in 2026. And given that this will result in a state income tax increase, some states will want to fix this as quickly as possible. But until that happens, there are no guarantees that it will happen. And tax filing season, of course, has already begun. So if and when states do enact legislation to retroactively update their conformity statutes to January 1st of 2026, in part to bring in the higher standard deduction amount, taxpayers in those states who filed before the law is changed may have to eventually file amended returns in order to take advantage of the higher standard deduction in the states that do eventually decide to conform to it. Additionally, the higher cap on the state and local tax deduction, known as the SALT deduction for short, will affect some states because many states offer a state deduction for local property taxes paid. And this provision is typically tied to the federal SALT deduction, usually with an addback for income tax deductibility to avoid circularity. And then finally, some states conform to the federal tax code in designing their own alternative minimum taxes, or AMTs, as well as their estate taxes. So in Colorado and Connecticut, AMT tax calculations may be affected by the changes that happen to the federal law, and in Connecticut, the state estate tax will likely be affected by the federal changes. So now that we've jumped right in and covered the really complex topic of IRC conformity, I want to go back to the ground level and talk a bit about the basic elements of individual income tax design. And we won't spend a ton of time here because I know this is familiar to many of you. But when talking about differences in income tax structures, one of the most basic design choices states have is whether to maintain single rate or graduated rate income tax structures. Currently, 15 states have single rate or flat individual income tax structures where all taxable income is taxed at the same rate. Meanwhile, there are 27 states and DC that have graduated rate or progressive income tax structures where there are multiple brackets, each with its own marginal rate. And this is probably obvious to those of you who work in tax policy or deal with these issues day to day, but a lot of people get confused by this, so it's worth mentioning that when you enter into a higher tax bracket, that does not mean that all of your income is exposed to the higher tax rate. Rather, it just means that the portion of your income above that threshold is taxed at that rate. So under an ordinary graduated rate income tax system, there should never be a time when earning more income is a net negative to you after taxation. But I say under an ordinary graduated rate system because there is a notable exception. 2 states, Connecticut and New York, have what are called recapture provisions, where there actually are thresholds at which taxpayers lose the benefit of lower marginal rates, either all at once or because the benefit phases out for higher earners. Nebraska is another state that used to have a recapture provision but repealed it. And also in 2020, Illinois voters rejected a proposal to amend the Constitution to create a graduated rate income tax that would have had a recapture provision. And under that failed Illinois proposal, there was a point at which very high earners could, by earning one additional dollar of income, increase their tax liability by almost $9,000. So again, these provisions are very rare, and they aren't how graduated rate taxes are supposed to work. But in an ideal world, recapture provisions wouldn't exist at all since they create steep and arbitrary tax cliffs where earning a small amount of additional income can result in a massive additional tax liability. And they also create an incentive for individuals and businesses to find ways to limit or otherwise reduce the amount of taxable income they earn in order to avoid facing a punitively higher tax bill. And recapture provisions are also very sneaky because when you look at the income tax rate structures in Connecticut and New York, it definitely isn't obvious that this is happening. So these policies can really catch taxpayers off guard. Two other elements of basic income tax design I want to cover are standard deductions and itemized deductions. As we've already alluded to, many states allow taxpayers to claim deductions for certain specified costs. At the federal level, taxpayers can claim itemized deductions that reduce the amount of their income that is subject to taxation for things like interest payments on their mortgage, donations to charity, the amount of state and local taxes they pay up to certain limits, medical expenses that exceed a certain percentage of the taxpayer's income, and other expenses. However, for most taxpayers, especially those who don't own a home or who don't have hefty state and local tax bills, claiming the standard deduction gives them more of a benefit than itemizing. In tax year 2026, the standard deduction is $16,100 for single filers and $32,200 for married couples filing jointly, and that amount is adjusted annually for inflation. So again, when a taxpayer claims a federal standard deduction or federal itemized deductions, that reduces their federal adjusted gross income in calculating the amount of federal taxable income that is subject to taxation. And like the federal government, many states offer their own standard deductions and their own itemized deductions. Some states offer standard deductions that are lower than the federal amounts, but there are many states that do offer the same standard deduction amount that the federal government offers. And then many states also offer their own itemized deductions. In some cases, states allow taxpayers to deduct a certain percentage of the amount of itemized deductions that they are able to deduct at the federal level. And some states also offer their own itemized deductions for other costs that are separate from what the federal government offers. Now, in addition to standard and itemized deductions, many states also offer personal and dependent exemptions, which reduce taxable income by a certain amount per taxpayer and oftentimes per dependent. The federal government set the federal personal exemption amount to $0 with the passage of the TCJA, and then the OB3 law made that policy permanent. But many states still offer their own personal exemptions, and because the federal tax code still has specifications for who qualifies for a personal exemption at the federal level, many states abide by those federal definitions for their own state personal exemptions, even though the federal exemption amount is set to $0. It's also worth noting that instead of offering a traditional personal exemption, some states like California offer this benefit as a tax credit rather than as an exemption. So now is as good a time as any to know the differences between exemptions, deductions, and credits. In short, the net effect of deductions and exemptions is fairly similar, but exemptions remove income from tax liability, while deductions subtract it. For example, in states that exempt Social Security income from taxation, when you say Social Security income is exempt, that means it is simply never part of the state's tax base to begin with. If it were deductible, you would subtract the amount of Social Security benefits you received from the tax base, which would require reporting the total amount of Social Security benefits you received. And to give an example of a deduction, take the itemized deduction for mortgage interest expenses. Mortgage interest is a cost, not a type of income, so you can't really exempt that cost from the income tax the way you would exempt retirement income from taxation. But you can deduct or subtract from your AGI the amount of money you paid in interest on your mortgage. A tax credit, on the other hand, is very different because a credit reduces your actual tax liability by the specified amount after you have already calculated your initial tax liability. For example, imagine your state has a flat income tax rate of 5%, and you are eligible to claim a $1,000 deduction. That means you'll be taxed on $1,000 less in income than you would have been otherwise, and that will reduce your tax liability by the $50 in taxes that you would otherwise have paid if that additional $1,000 had been taxable. By contrast, if you are eligible for a $100 credit, that $100 credit would be twice as valuable as a $1,000 deduction because the credit yields a true tax savings of $100. Another structural design feature I want to mention is the alternative minimum tax, or AMT. AMTs are now very rare at the state level, but they still do exist in some places like California, Colorado, Connecticut, and Minnesota. So I do want to mention them briefly. Basically, AMTs were originally designed to address situations in which some taxpayers, typically but not always high earners, can take advantage of so many deductions and credits that their effective tax rate is lower than policymakers think is appropriate. So if their tax liability is determined to be too low, they have to pay another higher amount. So essentially, AMTs create an alternative tax system where some filers are required to calculate their liability under both systems and pay under whichever system yields a higher tax amount. AMTs also add a lot of complexity to the tax code, resulting in high compliance costs for taxpayers and high administrative costs for states. So they're a pretty inefficient structural design choice. It's also important to keep in mind that AMTs reduce the value of tax credits and other tax preferences in certain ways, but many of those preferences were designed to incentivize certain behaviors. So regardless of whether various preferences are a smart policy choice or not, AMTs revoke that benefit and therefore remove those incentives in pretty arbitrary ways. As a short aside, I will say that in general, states offer too many tax credits and have made many of their credits too generous, including various economic development incentives. And there's a lot of research showing that many economic development incentives shift the timing or precise location of various investments, but often fail to actually generate meaningful new economic activity that promotes true economic growth. So I would argue that conducting a serious evaluation of the various tax credits that are on the books in your state is a better solution than using an AMT to essentially revoke the value of various tax benefits for certain taxpayers, since AMTs create additional non-neutralities in state tax codes. And I will say that many states have recognized the downsides of AMTs and have repealed them over time, but relatively few states have actually taken the time to clear out the underperforming credits in their state tax codes. The last subject I want to cover when it comes to the basics of income tax design is the issue of inflation indexing. Inflation indexing of state income tax brackets is commonly used to prevent what is called bracket creep, where taxpayers wind up paying higher effective tax rates on their income over time, not because their income is higher in real terms, but because the real value of how much income they earn has been eroded by inflation. And Alabama is a really good example of bracket creep because Alabama has made only very minor changes to its income tax structure since the state's income tax was first adopted way back in 1935. Alabama still maintains its original top marginal rate of 5%, kicking in at just over $3,000 for single filers and $6,000 for joint filers, and those bracket thresholds have not been adjusted for inflation over time. But $3,000 in 1935 is equivalent to nearly $72,000 today. So today, the vast majority of Alabama taxpayers pay the state's top marginal rate because it kicks in at only $3,000, whereas a much smaller share of Alabama taxpayers paid the top marginal rate in the 1930s when that was the equivalent of about $72,000. So this lack of inflation indexing has not only increased the number of taxpayers exposed to the top marginal rate, but it's also substantially increased the amount of each taxpayer's income that is exposed to that top marginal rate. So to prevent bracket creep like this from happening, ideally states should index their brackets for inflation, meaning bracket levels will change almost every year. And beyond bracket levels, it's also smart to index other major tax benefits for inflation, like the standard deduction and personal exemption, to preserve the real value of those benefits over time and to prevent unlegislated tax increases from occurring. Now, I'll say that states' approaches to inflation indexing vary widely, and I'm not going to get into all of that today, but we do have a paper on that subject that you can find in the resources for today's session, and Table 14 in our State Tax Competitiveness Index has an even more up-to-date table showing which states index their brackets, standard deductions, and personal exemptions for inflation. From here, I want to shift gears to talk about states' income tax treatment of non-residents, because in our highly mobile economy, many people owe income taxes not just to their state of residence, but also to other states in which they work or otherwise generate income. So it's important to answer the question, whose income are states allowed to tax? And the answer to that is that ordinarily states can tax income in one of two circumstances. Your home state, also called your domiciliary state, can generally tax all the income you earn from all sources, while other states can tax any income you actually earn in that state or that is sourced to that state. This means that if you live in one state but work either frequently or occasionally in another, you can end up in a position where more than one state can stake a legitimate claim to taxing the same share of your income. Two other common ways you could also have income sourced to another state are if you have capital gains on the sale of a property in that state, or if you have rental income from a property in that state. So to prevent double taxation, situation, in cases in which two states want to tax a portion of your salary, for instance, every state with an income tax offers residents a tax credit for taxes paid to other states. And these credits allow taxpayers to reduce their home state tax liability by the amount they actually paid to the other state, or by the amount they would have paid on that same income if it had been taxed exclusively in the taxpayer's home state, whichever amount is less. So for example, if your home state levies a 3% income tax rate, but you work in a state with a 6% rate, you will probably not be able to claim a credit for the full amount you actually paid in the state with the 6% rate. Rather, your home state will usually give you a credit for the amount of taxes you would have paid on that same share of your income had it been taxed only in your home state. Functionally then, this means that if all or some of your income is taxable in more than one state, your overall tax liability on that share of income tends to be that of whichever state's tax is higher. But importantly, double taxation is usually avoided thanks to credits for taxes paid to other states. However, there is a big caveat here that I'll get into in a little bit, because some states have convenience rules that can cause true double taxation for remote workers in certain circumstances. But before I talk about convenience rules, I do want to spend a little more time diving into non-resident income tax filing and withholding laws in general. So as I just mentioned, if you earn any income in a state besides the state you live in, or if you otherwise have income source to another state, you may be liable for non-resident income taxes in that state. However, states vary widely in how they define what constitutes sufficient activity to require non-residents to file and pay there. Currently, 22 states have no meaningful non-resident filing threshold and therefore require non-residents to file a state tax return if they spend even a single day working in the state. Another 19 states do have filing thresholds that relieve non-residents from filing obligations when they perform limited work in the state, such as when they work in the state for 30 days or fewer, or earn less than a certain amount of income there. States also have non-resident income tax withholding thresholds that require employers to withhold income taxes from the paychecks of non-resident employees when those employees spend time working in the state. And there are many states whose non-resident filing thresholds and withholding thresholds differ. So in looking at the map on the screen, it shouldn't be assumed that the withholding thresholds match the filing threshold. In our highly mobile modern economy, it's obviously quite common for people to travel for work and to spend even just a day or two working in other states. And some people travel to quite a few different states throughout the course of the year, so you can see how having strict non-resident filing and withholding laws can quickly yield huge compliance costs for individuals and their employers, even if their net tax liability isn't much different due to the credits for taxes paid for other states. So as a result, compliance with these laws tends to be very low when non-residents spend only a few days or even a few weeks working in another state, in part because a lot of Americans don't even realize that they're technically required to file in states besides their home state. Because unless their employer adjusts their withholding, many people don't even realize they're supposed to file. And I'm guessing that most of you probably don't file non-resident income tax returns in states that you go to work-related conferences in, and many employers, especially smaller businesses, don't actually adjust their employees' withholding every time they travel for work. Additionally, there is, of course, a cost to states of processing all these tax returns, so you can imagine a scenario in which it could cost more for the state to process all these low or $0 non-resident tax returns than they would actually receive in additional tax liability or tax revenue associated with those returns. So one relatively easy step states can take to relieve administrative and compliance costs for individuals, employers, and their state is to adopt meaningful non-resident filing and withholding thresholds. And when thinking about the design of these thresholds, it's worth noting that some states specify that filing and withholding relief under their non-resident safe harbor is available only to non-residents who live in states that do not levy an individual income tax or that offer a substantially similar exclusion. The justification for these so-called mutuality requirements is that some states only want to provide relief to taxpayers in states that would offer similar relief to their own state's residents. So these states are essentially saying that they'll only help you if your state will also help them. It's important to keep in mind, though, that individuals and employers don't have direct control over the policies in their home states, so mutuality requirements impose huge compliance costs on some taxpayers for reasons that are out of those taxpayers' control, while injecting a lot of non-neutrality into state tax codes by treating similarly situated taxpayers very differently depending on where they come from. So ultimately, a much more neutral approach is to do without the mutuality requirement language. Now, another thing to keep in mind is that even with generous filing and withholding thresholds, many states claw back this relief for professional athletes and entertainers as a way of capturing income tax revenue from the high earners who travel to their state even for a day. So you can debate whether that's good policy all you want, but I would argue those policies are also highly burdensome and not neutral for those who do have to comply. But regardless, most states keep these aggressive non-resident laws on the books for all taxpayers, not because they actually plan to go after the average taxpayer who spends a day or two working in their state for a conference or what have you, but because they want to go after the big fish, like the athletes and the entertainers or the CEOs who come in and spend only a small amount of time there in the state, maybe performing in a basketball game or a concert or something like that. At the federal level, the Mobile Workforce State Income Tax Simplification Act is a bill that has been introduced repeatedly in Congress that would address this issue by establishing a uniform 30-day filing and withholding threshold in states across the country for non-residents, with a provision that excludes professional athletes and entertainers from qualifying for that relief. But unless or until a federal solution like that is adopted, the onus is really on states to set policies that they think are reasonable. So another subtopic I want to cover related to non-resident income taxation is the concept of reciprocity agreements, also known as reciprocal agreements. Under a reciprocity agreement, two states, which are often but not always neighboring states, will mutually decide that when an individual lives in one of the states but works in the other, individual income tax filing and withholding will only be required in the home state, not the workplace state. And this is generally the case with a few exceptions, regardless of how much time an individual spends in that state and regardless of how much income they earn in that other state. So for example, an Indiana resident who commutes every day into an office in Michigan would only have to file pay and have their employer withhold in Indiana, while a Michigan resident who works in Indiana would only have to file pay and withhold in Michigan. These agreements are a smart solution for states that want to reduce administrative burdens for their own revenue department staff by reducing the number of non-resident returns they'll need to process and the number of credits for taxes paid to other states they'll need to issue. These agreements also significantly reduce tax filing complexity and compliance burdens for individuals and employers. Reciprocity agreements are especially helpful in commuter scenarios. It's important to keep in mind that they also provide relief in other situations, like when someone typically lives and works in the same state, but just so happens to travel for business to a state with which their home state has a reciprocity agreement. So for example, if you normally live and work in Indiana, but have a week-long business trip to Michigan, you'd be covered under the reciprocity agreement between those two states, even though someone traveling, from California would have to file if they spend even a single day working in Michigan. So there are a lot of efficiency advantages and taxpayer benefits to states having these reciprocity agreements. Currently, a total of 30 of these agreements exist among 15 states and DC. And as you can see from the map on the screen, these agreements are very common in the northern, midwestern, and mid-Atlantic states, but they have not yet gained momentum in the south, west, or northeast. And even among the states in which reciprocity agreements are authorized, states tend to pick and choose the states they actually want to enter into these agreements with. Because when the commuter ratio is really lopsided and one of the states receives substantially more inbound commuters than the other, those states are sometimes hesitant to give up that extra revenue. But a major benefit of doing so is the substantial reduction in administrative burdens for all the parties involved. So there are certainly trade-offs here, but especially when the ratio of commuters between states is more balanced, it can really benefit states and taxpayers to have these agreements in place. And I will say that most of the agreements that currently exist have existed for many decades, but the momentum in adopting new agreements has kind of stalled over the past few decades. So they are a really old concept, but they have a really practical application today, and there is arguably even a stronger need for them today, since working while on the go is way more common today than it was even a few decades ago. So a little while ago, I mentioned how credits for taxes paid to other states typically prevent double taxation in cases in which more than one state stakes a legitimate claim to the same income. However, in states that have what's called a convenience rule, the system can break down for remote workers. And so in certain cases, remote workers can end up being exposed to true double taxation. States with convenience rules consider you to have earned taxable income in their state if the company office to which you are assigned is in their state and you work outside the state, even if your contact with that state is very minimal, if you are deemed to be working outside the state for the convenience of the employer. Now, convenience of the employer is a term that is defined broadly and oftentimes vaguely, but it's generally defined to mean working from elsewhere as a matter of convenience rather than as a necessity of performing the job. So for example, New York has a convenience rule. If an electrician for a New York-based company spends a week installing electrical equipment in Massachusetts, that would be work that is performed in Massachusetts by necessity because that electricity equipment couldn't physically be installed anywhere but in the client's location in Massachusetts. However, if a New York-based company offers its employees remote work flexibility and a remote employee chooses to live in Colorado, that employee would be considered by the state of New York to be located in Colorado as a matter of convenience to the employer, even if it's really more a matter of convenience to the employee. So New York would levy its income tax on that Colorado resident's full salary, even if that individual lives in Colorado all year and has only very minimal contact with New York. In most normal situations, the Colorado resident could claim a credit for taxes paid to New York, but credits for taxes paid to other states are generally limited to income from work that was actually physically conducted elsewhere or legitimately sourced elsewhere. So if that Colorado resident tries to claim that credit, it will probably be denied. And that's frankly pretty understandable that when New York is trying to tax income that was physically earned in Colorado, Colorado wouldn't just willingly agree to that since that Colorado resident lived and worked in Colorado all year. But again, if that credit for taxes paid to other states is denied, as it probably will be, that person will owe income taxes on their full salary to both Colorado and New York. So currently 5 states, Alabama, Delaware, Nebraska, New York, and Pennsylvania, have pretty full-fledged convenience rules that expose remote employees to true double taxation if those employees work for companies based in convenience rule states but live elsewhere. And then another 3 states, Connecticut, New Jersey, and Oregon, have limited convenience rules that apply only in certain circumstances that are mentioned in the footnote to the map on the screen. It's important to keep in mind that convenience rules are constitutionally suspect because under the U.S. Constitution's Dormant Commerce Clause, taxpayers must have some level of minimum economic contacts with a state to be subject to its income taxes and must in some way at least avail themselves of the benefits of the state's economy. So New York's courts concluded that working for a New York-based company with New York offices meant that employees were availing themselves of the state's economy or state's market, and that this represented sufficient contacts to tax their income. But it's worth pointing out that New York does not tax all U.S.-based employees of firms that are headquartered in New York, even though all of them benefit from the company being headquartered in New York. So here, the state implicitly recognizes that some claims of taxable nexus with a state are too tenuous, but where the line should be drawn has not yet been determined by either Congress or the Supreme Court. So given their potential to create true double taxation and to discourage remote workplace flexibility, as well as their constitutionally suspect nature, we would encourage states to avoid adopting these convenience rules. Now, everything I've discussed so far assumes we know which state is your home state, and for most people, that's pretty obvious. But for some people, especially affluent taxpayers and retirees, those people often split time among 2 or more states. And there are, of course, advantages to establishing a low or no income tax state as your domiciliary state, even if you spend a lot of time in another state, since only the home state will generally tax certain types of income, like retirement income and investment income. But if a state with an income tax is your home state, that state will have a pretty strong interest in establishing that they are indeed your home state. So this can all get pretty complicated pretty quickly since each state has its own set of rules, which is why tax advisors make pretty good money at helping clients figure all of this out. But the most straightforward rule, which many of you are probably familiar with, is the 6 months and a day rule, where a state you spend 183 or more days in will often presume that you live there, although this can be disputable. So as a result of this law, there are a lot of snowbirds who make sure they spend exactly 183 days a year living in Florida, even if they also have a home in another state. But even spending 6 months in a day living in a state is not necessarily enough to establish domicile there, depending on the state. States can, and in some cases will, also look to other factors to determine whether you might actually live in their state, even if you spend less than 183 days there. So for example, if you still maintain property or spend significant amount of time in another state, even if it's less than 183 days, that state might point to other factors, like which state issued your driver's license, where you're registered to vote, where your business interests are, where you worship, where your doctor is, what address is listed on your insurance policy, where your pet lives, or which house you keep your expensive artwork in. And it has sometimes happened where two states have both decided that they are the taxpayer's domiciliary state, with both staking claims to taxing that person's entire retirement income or investment income or other forms of income that are typically only taxable in a person's home state. Now, we haven't really mentioned local income taxes yet, but when speaking about state income taxes, it's important to keep in mind that some states allow cities and counties to levy local income taxes on individuals and businesses in addition to their state income tax. Local income taxes aren't very common, though. Only 6 states rely heavily on them for local income tax revenue, while 10 additional states rely on them as a modest source of local revenue. But across the 16 states that allow at least some form of local income tax, they are levied in over 5,000 different jurisdictions. And across the states that allow local income taxes, there are a variety of different ways they are administered. Some states allow direct collection, where the municipality itself is responsible for all aspects of the tax, including its administration, assessment, collection, and enforcement. And then in other states, known as piggyback collection states, local governments work with the state Department of Revenue to piggyback on the state's tax system, relying on state definitions of income and oftentimes giving the state audit authority. In these cases, the tax base is set by the state, and the state administers the tax on its own state tax forms, but local governments get to set their own rates. And then finally, some states have a hybrid collection method where local governments use state definitions of income, but local governments are the ones that are responsible for tax collection and administration. As you can probably imagine, local income taxes add a lot of complexity to the tax code. They also come with high administrative and compliance costs and further weaken economic growth by adding yet another layer of taxes onto individuals and businesses' returns on their labor and investment. So they are a far less efficient and more harmful source of revenue than local property taxes and local sales taxes. But it's important to be aware that they do exist in some states, and in some cases they apply to both residents and non-residents alike, although that varies greatly by state as well. Now, before we wrap up, I do also want to share what we know about the economic implications of individual income taxes from the economic studies that have been conducted on this topic. But first, one very important fact to be aware of is the fact that the vast majority of businesses pay individual income taxes rather than corporate income taxes, because most businesses are structured as pass-through businesses, where business income passes through to the owner or owners. This is the case with S corporations, partnerships, LLCs, and sole proprietorships. And while pass-through businesses are often equated with small businesses, that's not always the case. There are some pretty large S corps out there. So individual income taxes fall on both individuals and the vast majority of businesses, which is important to keep in mind when considering their economic effects. And when it comes to the economic effects of various taxes, there's an old adage that whatever you tax, you get less of, and that's definitely true here. When you tax people's and businesses' returns to labor and investment, you're going to get less labor and investment. In comparing the income tax with alternative sources of revenue like the sales taxes fall on present consumption only, while income taxes fall on present consumption plus savings. In other words, income taxes reduce your capacity to spend now and in the future, while sales taxes just reduce your capacity to spend now. As a result, sales taxes are more economically efficient than income taxes. Many policymakers do tout the greater progressivity of income taxes compared to sales taxes. As with everything in public policy, there are trade-offs. And again, one major trade-off is that income taxes have more of a negative effect on economic growth producing activities like labor investment than do sales taxes. And there are a lot of different studies on this. One of them by Mertens and Robin in 2013 found that at the federal level, a 1 percentage point reduction in the average income tax rate raises real GDP per capita by 1.8%. Additionally, another 2017 study by Zarud and Raw found that a 1 percentage point increase in a state's individual income tax led to the closure of between 0.2 and 0.4% of the state's pass-through businesses. It's also important to keep in mind that the effects of individual income taxes on migration are especially pronounced at the state level compared to the national level, because it is far easier for individuals and businesses to move across state lines to avoid burdensome tax policies than it is to change countries. And lower income tax rates, especially lower top marginal income tax rates, are closely associated with net inbound migration, and we've consistently seen that play out with large numbers of people moving to no and low income tax states year after year, like Florida, Texas, Tennessee, Arizona, Nevada, Idaho, North Carolina, Indiana, and others. Now, of course, states compete in many different ways, and taxes are just one of those ways. People and businesses care about a lot of different things like quality of life, cost of living, education systems, employment opportunities, social, cultural, and governmental amenities, and weather, just to name a few. So taxes are definitely not the only factor, but they are an important factor, and they are one that is within policymakers' control. So it's worth keeping in mind that states can reap the benefits of tax reform relatively quickly, while it can take many years to see the economic benefits of investing in an overhaul of the state's infrastructure system, for example. And then finally, income taxes, as you can see in the chart on the screen, are also more volatile than sales taxes, and that's pretty consistent across the board. The final topic I want to cover before we close is to share about the recent individual income tax trends we are seeing in states across the country. By far the biggest trend we're seeing is that many states have consistently been reducing their individual income tax rates over time, and this is a trend that has been going on for several decades, but has picked up with renewed vigor in the post-COVID-19 environment. So the chart on the left of the screen shows that in 2006, 21 states had top marginal individual income tax rates between 5 and 7%, but only 12 states have top marginal rates in that range today. Similarly, 2 decades ago, only 15 states had top marginal rates below 5%, but 26 states have top marginal rates below 5% today. And just since 2021, so since when states are beginning to return to normal legislative activity after the initial pandemic-related disruptions, 26 states have reduced their income tax rates to provide a net income tax cut, with 23 of those states reducing their top marginal rates. So that is a huge number of states reducing income taxes. In that same time, only 6 states and DC have increased their income tax rates and increased their income taxes on net in some capacity, including in some cases by uncapping their payroll taxes or creating a surtax on investment income. So those 6 states that have increased their individual income taxes in some way since 2021 are California, New York, Maryland, Massachusetts, Minnesota, Washington, and DC. So while far more states have reduced income taxes than have increased them, the result of this is that we are seeing a notable divergence, as is shown in the chart on the left, in that more states have very high top marginal rates now than they did even a decade ago. So specifically, while only 1 state had a top marginal rate of 10% or higher in 2006, 6 states do today. But again, the overall trend, as you can see in the chart on the right, is that the average top income tax rate is declining rapidly and has gone from just over 7% in 1977 to 5% today. Another notable trend is that states have been moving from graduated rate to single rate individual income tax structures at a rapid pace. From 2021 to 2026, in the span of only 5 years, 7 states adopted and implemented laws moving from a graduated rate to a single rate income tax structure, and Kansas has tax triggers in place to phase in a flat rate over time as revenue conditions are met. To give you a sense of just how notable that is, in the whole history of state income taxation from 1912 through 2020, only 4 states, Colorado, North Carolina, Utah, and Kentucky, had ever made that same conversion until 2021. But since 2021, Arizona, Idaho, Mississippi, Georgia, Iowa, Louisiana, and Ohio have all implemented single rate structures, and other states have expressed interest in moving in that direction as well. So that wraps up everything I wanted to talk about today, but we have a number of resources that dive into all of these topics in greater detail available on our website, so I hope you will check all of these out. And again, if any questions have arisen for you as you've watched this webinar, please don't hesitate to send me an email at klawhead@taxfoundation.org. Thank you all again so much for tuning in today, and I hope you enjoy the rest of your day.